The end of the personal tax year is right around the corner, which means you are quickly running out of time to reduce your tax bill. So in this video, I'll explain every tax relief you need to claim, consider, or cross-check in order to keep as much of your hard-earned cash in your pocket as possible. If you want to get in touch with me, you'll find some links in the description where you can speak to me directly, so feel free to go and check those out. Anyway, let's get into the video. First up, you want to decide how much you want to declare personally. The first thing to think about before the tax year ends is how much income do you actually want to show on your self-assessment. If you run a limited company, you have flexibility, okay? You can choose how much to take as salary, how much to take as dividends, and how much to leave in the business. That flexibility allows you to control which tax band you fall into. For example, keeping your income below £50,270 means your dividends are taxed at 8.75% instead of jumping up to 33.75% for the 25-26 tax year. If you're a sole trader, you don't have the same flexibility around timing quite the same way because your taxable profit is your taxable profits. You can't allocate it somewhere else. However, you can still influence the final number by managing expenses, pension contributions, and investments all before the 5th of April. In both cases, the key to tax planning here is to understand where your income is sitting in the first place in regards to the thresholds, and then being intentional about what you can do to allocate or declare that money elsewhere. The second thing is to consider your spouse's income level. Tax planning is rarely just about one person, it's about the household. Each individual has a personal tax allowance of £12,570 and their own basic rate band, again up to about £50,000. If your spouse is earning little or nothing, there may be an opportunity to make sure you're using their allowances before increasing your own income. For limited companies, this could mean paying dividends to your spouse if they own the shares, or maybe putting them on the payroll if they're generally working for the business. And again, as a sole trader, it may be just worth employing your spouse through the sole trader business if they're generally involved in running it. The principle's the same, just make sure you're using both sets of allowances rather than letting one go unused. The third thing to consider is if you're thinking about buying a property in the next 18 months, this is where tax planning and life planning collide a little bit. Reducing your taxable income is great for lowering your tax bill, of course, but if you're applying to go for a mortgage at some point, lenders are obviously going to look at the income you've declared. For limited company directors, that usually means salary plus dividends again. For sole traders, it's just going to be the net profits shown on your tax return. So if you are wanting to go for a bigger mortgage in the future, in the next 18 months, you may have to just suffer paying extra tax now so you can borrow more in the future. So just make sure you're bearing that in mind when you're actually doing your tax returns and seeing what you want to declare. The fourth thing we can use as a tool, it is pensions. Now, they're boring, of course, but they are one of the most powerful tax planning tools available if you're a sole trader or if you're a limited company. For limited companies, employer pension contributions are deductible against your corporation tax bill. So if your company contributes £10,000 into your tax bill and you're paying 25% corporation tax, you're going to save 2.5 grand just like that. On top of that, there's no income tax or national insurance for you to pay personally. For sole traders, pension contributions reduce your taxable income. So if you're making £6,000 of profit and contribute £10,000 into your pension, your taxable profits will reduce down to £50,000, which could pull you down from the 40% tax rate and push you into the 20% tax rate for your income tax. That is a great way for you to save money and manage which tax bracket you fall into. Number 5 is make sure you are reclaiming your household bills through your company. If you work from home, make sure you are claiming for it. For limited companies, the company can reimburse you for the use of your home. Even something modest like £75 per month adds up to £900 per year, which can reduce your company profits, of course, and then save you corporation tax. Now, for both sole traders and for limited companies, you can do this, okay? You've used HMRC's flat rate of reclaiming £312 per year, or you can use the apportionment method where you actually calculate what portion of your bills relates directly to your company, sole trader or limited company, and reduce it that way. Now, usually the apportionment method is going to save you more in tax than the flat rate method, but there are two options available to you there. Number 6, we're looking at reclaiming mileage. Mileage is simple but often forgotten. If you use your personal car for business, HMRC allows you to reclaim 45p for the first 10,000 miles that you drive per mile. If you drive 5,000 business miles in the year, that is £2,250 of allowable expenses you can put through your limited company or through your sole trader. That reimbursement is tax-free to you and reduces your corporation tax. So really, really useful to use. It's one of the easiest ways for you just to make a small adjustment to your accounts when you're doing your year-end accounts and reduce your tax bill. Number 7, it is utilizing your ISA allowance. ISA allowances do not reduce your year-end tax bill, but they are crucial for long-term planning. You can invest up to £20,000 per year into an ISA, and all the growth is free from income tax and capital gains tax. If that £20,000 grows to £30,000 over time, that £10,000 gain is going to be completely tax-free. Whether you're a sole trader or a company director, using your ISA allowance protects your investments from future tax. Make sure you're using it before the 5th of April, because that is when the allowance for that year is going to disappear forever. Number 8 is reducing your payments on account, which lots of people don't realize they can do. Payments on account affect many sole traders and directors with significant personal tax bill. If your tax bill was £12,000, HMRC may ask for £6,000 of that in January and £6,000 of that in July as an advance towards the following year. If your profits are falling, you may be able to reduce those advance payments. It's not avoiding tax, but what it's doing is it's giving HMRC money earlier than necessary. So if you are expecting your personal income to drop in one particular year, let's say the previous year it was higher because you were going for a mortgage application and this year it's lower, if you submit your self-assessment early and can demonstrate that your payment on accounts should be lower, you can reduce the amount of tax you were meant to pay in the July and keep that money in your pocket. The next video that comes onto my YouTube channel is all about how to actually do this. So if you aren't already subscribed to the channel, please subscribe now and you'll be the first person to see that video when it goes live. In fact, most of the people who watch these videos aren't subscribed. So please do me a favor and press subscribe now, because the more subscribers I have, the more resources I can throw into putting these videos out. I can have more videos, high quality videos, and all the rest of it. So I'd really appreciate it if you could just press subscribe now. Number 9 is staff parties and annual functions. If you run a limited company with employees, you can spend up to £150 per head per year on staff parties without creating a tax benefit. For example, if you had 4 employees, you could spend up to £600 on a staff event, claim corporation tax relief on the full amount with no tax charge on the employees. Sole traders without staff obviously cannot use the same tool and the same approach, but the broader tax planning points stay the same. Structuring rewards and benefits correctly can often be more tax efficient than simply increasing pay. Number 10, it is subscriptions and training. Review what you currently are paying for personally, because there may be some professional subscriptions, softwares, or trainings that you are still paying for in your personal name. Don't forget, these are allowable expenses. For a limited company, this will again reduce your taxable profits and save you corporation tax. For sole traders, it reduces your taxable profits and therefore reduces your income tax and national insurance. Now, to put this into context, okay, let's say you're spending £1,500 per year in business-related costs personally, and you're in the 40% tax bracket. That is effectively costing you £2,500 per year of pre-tax income. That's because in order for you to have 1.5k to spend on these different costs, you need to earn about £2,500, then have been taxed, and then be left with £1,500 to actually spend on those things in the future. So just making sure that expenses are actually going through the business is going to be a massive tax saving for you. Number 11 is bringing expenditure forwards. Okay, timing matters when it comes to tax planning. If you're planning on buying some equipment in April, consider whether it makes sense to purchase it before April. For limited company directors paying 25% corporation tax on a £5,000 purchase, that'll be £1,250 reduced off your tax bill. For sole traders making a £5,000 purchase, if you're a 40% taxpayer, that could be saving around £2,000 once income tax and national insurance are considered. It's not all about spending for the sake of it, it's just about being strategic with the timing of expenses if you're going to be incurring those costs anyway. Number 12, it's being aware of the dividend tax changes, okay? Dividend tax rates are increasing next year. Limited company directors may want to consider declaring dividends this year, more income this year, rather than declaring it next year, because next year your dividend tax rate is going to be increasing by 2%. For example, when the tax rates increase from 8.75% to 10.75% for basic rate taxpayers, which is going to be happening next year, on a £30,000 dividend, that would mean £600 roughly more in tax next year than it would be if you were to declare that money this year. This doesn't apply to sole traders because they don't pay themselves through dividends, but it's just worth being aware if you are a limited company director. And number 13, it's making tax digital. It's just worth being aware of the making tax digital rules, because this is going to affect a huge number of sole traders and landlords over the next couple of years. HMRC is moving towards a system where instead of filing one tax return per year, i.e. your self-assessment, you need to start submitting quarterly tax returns through approved software. For many sole traders, this is going to mean more admin, more reporting, probably more higher accounting fees just for you to stay compliant. This is where it becomes increasingly important to consider whether remaining self-employed is the best structure going forwards. This could be the best time for you to move into a limited company just to get you around all these making tax digital rules for income tax. So if you are thinking about incorporating and you aren't sure whether to do it or not, then again, just contact me using one of the links in the description below and I can talk you through the full thing. So that is your year-end checklist. Most people will just miss like 2, 3, or 4 of these, but they can all add up and make a difference. And make sure you're being really, really thorough. If you want to just take this checklist and go to your current accountant and make sure we're doing everything correctly, of course, go and do that. I think that'd be a great idea as well. This is the difference, okay? This list is really the difference between a reactive accountant and a proactive accountant. And you can just see by going through that list where things get missed, how it can easily add up to thousands of pounds of tax saving being missed. If you are a business owner and you're unsure whether you are structured correctly, whether you are extracting your income efficiently, or whether you know what is changing you and all the different tax rules, then now is the best time for you to sort it out. If you want to work with an accountant who is genuinely proactive and super tax focused, all the links are down in the description. If you do inquire, your inquiry comes through to me directly and you will speak to me directly. Just make sure you don't wait until after 5th of April, because that's when you might be a bit too late to act. I hope this video was useful. Like I said earlier, if it was useful, please press subscribe. I really do appreciate it. And I'll see you in the next video. Thank you.